Hey there, Jonathan Rodriguez here for Rich Retirement TV, and today I want to answer another burning question that I get from retirees all the time. What stocks are going to get me the biggest return with the lowest amount of risk? And for me, it's a very easy answer. I love the Dividend Aristocrat Index. If you're unfamiliar, these are stocks that pay dividends, good dividends, but they've got three simple qualifications that set them above the rest of the dividend stocks out there in the market. Number one, they're all constituents of the S&P 500 index, which is the big blue chip index of large cap stocks. They have paid an annual dividend and boosted it for at least 25 consecutive years. And they have a minimum market capitalization of $3 billion. So no tiny stocks, and only the dividend payers with a strong history of paying out dividends. For retirees, this is your set it and forget it type of stock. These stocks have done very well over many years. To be paying out dividends for as long as they have, they've prioritized cash flow. They're making sure that they've got enough cash on hand to pay out those dividends no matter what. These are mature businesses that are often leaders in their space. They've got strong balance sheets. They got lots of cash, low debt, and they're in markets where they've carved out, a wide economic moat there, and they have the lowest risk of cutting their payments over some other dividend names that have done just that, especially in the COVID-19 era. So these are the names I always go back to for retirees, and let me just show you why. All right, here we go. So this chart here from Bloomberg is a very easy chart. It shows you the white line there is you see here. This is the Dividend Aristocrat Index. It has since 2000 returned on a total return basis, which is stock gain and dividends, 584%. And it's more than doubled the performance of the S&P 500 index on a total return basis. It's only that index has only gone up 219%, and it's shown remarkable strength. The Dividend Aristocrat Index, that is, during market downturns. It held up during the 2000 dot-com bust, held up during the 2008 financial crisis, and it's held up very strong during the current COVID-19 crisis. So very strong list of names here to draw from it. The one name from this index that stands out to me is Lowe's. And let me go ahead and show you their chart here. There's three big reasons why I love Lowe's right now. They've paid out 56 years of dividends consecutively and boosted their dividend payout. They are a market leader in retail. They're poised to do well in the COVID-19 economy. I don't know if you had a chance to take a look at the numbers this week, but retail sales for last month just came out, and it was a blowout. Completely smashed expectations. And Lowe's, being in a part of the market that or part of the retail market that caters to people that are stuck at home right now, they've done very well. Even though people are stuck at home, it's nice outside in many parts of the country. So people are doing projects outside. They're working on their decks. They're working on their gardens, like my wife. They're out there doing things in their home to make it more comfortable for them being at home. Or a lot of folks are going out there and fixing up their houses, preparing to sell them. So there's still a robust home or housing market, and Lowe's is taking a complete advantage of that right now, being where they are. Analysts are bumping up their earnings estimates. The stock just received two buy recommendations from two big Wall Street firms, both of which had price targets on the stock 15% above where the stock's trading right now. But the last reason that I really love Lowe's right now is their stock chart looks fantastic. If you take a look here, just in the last 2 months, the stock has recovered all of its coronavirus crisis losses to punch a new all-time high just a few weeks ago, and it's pulled back a little bit, but it's climbing, as you can see right here, just climbing its way back to that high here. Oh, there it is. But what the stock just did in the last 2 days is what has my attention here. You see this? This is what's called a golden cross, and it is a very bullish signal for the stock. The red line you see here, this is the 50-day moving average, and the blue line you see here, this is the stock's 200-day moving average. So the red line is the shorter term moving average, and the 200-day, the blue line, that's a more long-term average. And when you see a stock pop up above both of those averages, the 50 and the 200, and you see that 50-day moving average cross above the 200, that's a golden cross, and that tells you that the long-term and the short-term trend of the stock are both heading north, heading higher, and that's very bullish. Even if the stock pulls back, it's supported by a long-term uptrend. So that's honestly one of the best technical indicators you can use. That's simple, to identify a bullish name like this. And Lowe's, again, they're right now they're paying a 1.7% yield. It's not shooting the lights out, but when you combine that with what the stock is doing in terms of capital appreciation, you throw in the dividend, you got a strong name here. And really, this is a stock with again a company that checks all the boxes for me. They've got strong sales, strong balance sheet. They're only paying out 35% of their earnings on dividends, so they've got plenty of cushion to continue paying the dividend and to boost their dividend moving forward. So Lowe's is a great name from the Dividend Aristocrat Index, which is my favorite index for retirees for big returns and low risk. So take a look and do some homework on that index. See if there's any other names that are on that list that you might like to help boost your retirement savings moving forward. Well, thanks so much for watching today's video. For Rich Retirement TV, I'm Jonathan Rodriguez, and I'll see you next week.